Hey everybody, welcome. Thanks so much for having us. My name is Richard Moglen. I'm waiting for a presentation to maybe come up here. But thanks so much for joining us. We'll be talking about alternate entries and advanced entry tactics and how you can manage risk along the way. And with me is Ross Haber. Ross, you can introduce yourself.
Hi everyone, I'm Ross Haber. For those of you who may not know me, I work with Richard at TraderLion. I am author of our top 10 report and chief market strategist. So.
Yeah. Sounds good. All right. Click. Oh, click. All right. So once again, I'm the director of education over at TraderLion. I'm also the host of the TraderLion podcast, as well as the Market Chat podcast, where I interview top traders, U.S. investing champions, and hedge fund managers. And Ross, as he said, is our chief market strategist and the author of the top 10 report. Here's a little bit about what we'll cover in today's video. I won't go through every bullet point, but we'll be kind of taking it from the top, talking about how to analyze the market a little bit, how to pick stocks, select stocks, and then go through a few setups and how to manage risk along the way. So first things first, I think this is incredibly relevant, especially considering the current market conditions we are in. And Ross, I'd like to hand it over to you and talk about kind of how you interpret the market conditions and also how that comes into play with trading growth stocks.
Absolutely. So as far as general market conditions go, for those of us who may be position traders familiar with Bill O'Neill's canceling system, I'll just start with what comes right out of his book, what he's told me a million times. If you don't get the direction of the general market right, doesn't matter if you get everything else perfect as far as your stock picks would be, nothing else matters. 3 out of 4 stocks follow the general market. When the trend is not in your favor, at the end of the day, you're just asking for it. It's just a matter of time before you run into trouble fighting the trend. So right now, as we know, we are in the midst of a bear market. We're down well over 25%, which I know people use as the official number for the definition there, which leaves us waiting for a new uptrend to form. A lot of leadership has, really fallen apart. And so now, what we're waiting for, and this is super important, we're going to be looking for a follow-through day, which would be a potential signal that the market has put in the bottom and is following through. That is our quantitative sign to start looking for our qualitative signs, which would be the health and breadth of the market leadership. What's leading? Is it traditional growth or is it cyclical, more defensive type names? And for example, let's say it is a traditional group of stocks that is leading. Let's say we started to see, and I think it was software, computer security software. That was one of the groups that had been leading in 2020. The industry group rank had started to creep up. Some of the stocks looked like they were going to start to participate. That fell apart in a hurry now. So, and I don't want to go on too long here. The context was a lot of those stocks have already had tremendous moves up into that point. They were getting a little bit tired. So understanding that we had just gone through a big uptrend and a lot of these stocks that we're trying to kind of reform had already, so what we wound up seeing is a lot of late stage basis form, and these stocks have since then broken down, fallen apart. The few stocks that were holding up have started to get hit. So right now, we're just stuck in the middle of an ugly downtrend bear market. Nobody knows when that's going to change, but at the end of the day, you want to make sure that we've got an uptrend in place. Leadership confirms the uptrend. We've got confirmation of that leadership, and as you're getting in, the most important thing is managing your risk. So
yeah, I'll take it from there. And the reason we're talking about the market trend and why that's so important is because the setups we'll be talking through work best in an uptrending market. And right now we're in a correction. This is not the optimal time to be trying these out. We got to wait for that fall through day and for those leaders really to emerge. And going from that, once we've got the market trend in place here, the next step is picking the right batch of stocks to trade. And we talk about building our universe of stocks, and what we want to look for goes along with the traditional CANSA methodology. We want to look for superior sector and group performance, excellent earnings, revenue growth, an estimate, something that Eve talked about earlier in a presentation. And we also want to see new and disruptive products and services. And basically, we want the company to have the potential to change how we work, live, and play. And in addition to those kind of fundamental factors, what we also want to look for is what we call leadership blueprints, which are technical criteria that signal to us that a stock is under accumulation by institutions and has that strong potential. So these are price and volume characteristics such as huge volume spikes to the upside, tight price action, strong uptrends, all these kind of point us towards that this stock is under accumulation. And I just mentioned this, we want to see a stock in an overall longer term uptrend. We always want to be trading with that longer term trend. This can be determined by a rising 200-day moving average. And as I mentioned, we want to see a stock that has superior relative strength and not just one stock that has great relative strength. Ross tells me all this time, we want to see an overall group that is shaping up together and really standing out from the crowd. And last year, or not last year, in 2020, as Ross mentioned, the computer software security group, not just one of those stocks was acting well, but basically the majority of them were basically trading at relative strength new highs just as the market was turning up off its lows. And that was a big clue for us to really get involved in that group. So with all that covered, talking about the overall context of the market, why that's important, why we want to focus on a select few high potential stocks, why that's important. Now let's go ahead and dive right into our first setup today, which we call the launching pad. And with that, Ross, I'll hand it over to you. Kind of what do you kind of want to look for in terms of the setup, in terms of the chart, and how do you use this while also managing risk to enter stocks?
So very simply, the setup is when you see a stocks, as we can see the launching pad setup, you see all of our moving averages there have started. So the stock has you can see, shook out below its 200-day moving average. And as it's starting to come up its right side, you can see all of the moving averages now are starting to curl up and convert to where they cross. So exactly. So when I start to see that happen, I see if I see a stock or a group of stocks shaping up and I see it looks like maybe we're putting in a potential bottom, a right side start to form, I'm always looking, one of the first things I like to see is those moving averages begin to cross up underneath the price. It doesn't have to happen, but this is just an extremely, what happens is, and we're gonna go through a couple of other, we're gonna go through our consolidation pivot as well as our declining tops line, which often lines up with that launching pad setup. So each of these three things is a very simple thing to look for in and of themselves. But they wind up being very powerful in terms of being able to manage risk, maximize profits, and that sort of thing. So, I mean, this is your basic setup. You start to see a stock put in some sort of a bottom. Let's say here, we're forming it around that red line, which is the 200-day simple moving average. And you can see those moving averages are all turning up in a hurry. Volume's coming into the stock as we push higher. And you can see once we push through that point, that becomes that significant area of resistance becomes a significant area of support. And you'll see in many cases that'll often line up with our declining tops line and consolidation pivot, giving it that much more significance. So here's our first example. I'm not going to spend too long. You can see the first setup we have here fails. We've got the cross, the market started, or the stock, which is applied materials, started working its way up the right side. But you can see volume actually started falling off below average. The stock makes it only, it starts to lose momentum. Now, the beautiful thing about using these techniques is they're so early in the base that by the time it starts rolling over, you've got plenty of time to decide how to manage that, how you're going to manage the risk, how many shares did you buy, what's your average price. And the idea is I always want to be out wishing I was in than in, rather than in wishing I was out. So I will use that as my opportunity to get away with maybe a small gain, a small loss. It's not perfect anymore. It started rolling back over. So now I'm out and I'm watching again, because the idea is if this stock does work, I also want to have preserved not only my financial capital, but my mental capital. So when it comes time that I see this setup all again, I don't hesitate buying this stock. And that's a big part of, managing financial capital and your emotional, mental capital as well. This does a great job of both. And you can see here, this time we've got that launching pad set up again. And you can see the volume actually comes in this time. And not only is it giving you a super early entry low down in that spot where, if you wanted, you could pyramid as it's breaking through highs, which would be your textbook base breakout that Bill talks about and how to make money in stocks. So what, oh, I lost my train of thought, everyone.
Yeah, I can add something too.
Please do.
Yeah, we listened to a great presentation from Brian Shannon, and I saw there was a question. I'll get to you in a minute,
There it is.
Kathy. But I wanted to point out that this often lines up with if you put an anchor VWAP at the top of the base. This launching pad setup, we often see that anchor VWAP. You know, if we use this example, if it's anchored here, come back and basically offer resistance right at the top, right as those moving averages are converging under price. So these kind of very much complement each other, and then we can use our entry tactics to enter that stock. And yeah, we've got a question here. So from the top of the prior base, so wherever that base starts, that's where you want to place it. And Kathy, we had a quick question from you. Yeah, Ross, I'll let you take that one.
Sure, it's very hard to see if you look up in the, so at the top left, we've got our, oh, it doesn't, you know what? It seemed to cut off the number. It's a great question, and that was not.
So it's the standard one. So it's the 200 simple moving average, it's the 65 exponential moving average, the 50 simple, the 23 exponential, and then the 10-day simple moving average.
And the 21 actually.
And 21 as well.
Simple. So 10, 21, 50, and 200 simple, 23 exponential, and 65 exponential are what I've got up there. Yeah.
So this is different than stage analysis. This is a short-term time frame. All of these are daily charts. So if you looked at a weekly chart, this would actually line up pretty closely with that transition from a stage 1 base to a stage 2 base. And that's a really great observation. Now, we can come back to that later, but let's push on. But I think that's a great way to look at it as well.
One sec before you move on, just because I regained my thought. Notice how this stock, once we've broken through that launching pad setup, it just takes off. It never really consolidates again. For more or less, that's a straight up off the bottom move. And when I see a stock move from the bottom of its base straight to new highs in a matter of just, I don't know, 3, 4, or 5 days, I find in general, and in this, and you can see here, not always, a stock will come back in and retest. So in this case, if you didn't buy it early and you started, I will often ignore that stock going out through the top just because it's much more difficult to manage risk, and I will wind up often missing a stock because of that. So this is, I can't tell you how many times that working my way in a day or two early has made all the difference. Whereas if I would have waited for that, textbook perfect spot, I would have missed it for one reason or another because it was too extended, it gapped through or whatever. So I have found this to be an extremely helpful way to, again, manage risk and maximize your gains.
Yep, perfect. Let's move on to the next setup here, which actually often coincides with that same spot on the chart. So yeah, Ross, can you talk a little bit about the descending tops line and first how you identify on the chart and what you look for?
Sure. So the declining tops line, or that declining tops trend line, as you can see, is going to form 9 times out of 10. You're going to see, now that's a later one. There are earlier ones that can be drawn as the right side is forming, but it's another, it gives you another significant spot as a stock is forming the right side of the base early prior to your base breakout pivot, where you would typically be waiting for. It's another spot to get into the stock. And so you can see that trend line needs to touch at least 3 highs. So we've got that high on the left. You could call that a sloppy deep V cup and handle if you wish. It's not an official cup and handle, but the high of that handle would happen to be our consolidation pivot, which we're going to discuss next. You can see that declining tops trend line goes right through the consolidation pivot and giving you a spot to enter that stock early. Again, here we've got a little more clearly, you can see this stock has been forming forever, but volume is huge here. It really starts to dry up just before that declining tops line break. And you can see it dries up, we tighten up, it starts building the right side. Those moving averages cross just after. And you can see there, once again, once you push through that significant area of resistance, I always call it, on big volume, majority of the time, if all of everything else is in place, that's going to work out for you really well. And if it doesn't, you've got a very easy way to sidestep that with minimal damage and not only protect your account, but again, your emotions. You won't think twice about having to work your way back in because it gives you, several other spots to buy the stock, even if you didn't buy it back the very next day or what have you. It really leaves your options open.
Yeah. And Ross, is a key thing for you when you're looking at this dry up in volume before we start to see that push through that DTL?
Yes, so anytime that I'm looking at this, I want to see, very good point, you've got to see healthy constructive volume along with it. So as that stock is forming its bottom, what is healthy constructive price action? We want to see high volume on up days, lower volume as it's pulling back. We like to see price ranges and price closes tightening as volume is declining, just as you're seeing there. And you almost got, I'm not playing, yeah, that big hammer candle right there. We don't have the huge volume with that one, but a lot of times you will get that sort of action in and around the bottom. So I'm watching that, and I will watch that price volume action thereafter. Again, I'm watching what stage are we in, what are the peers in the group doing, where are we in this is all going to make a big difference. If it's just one stock, maybe there's another one in the group, and I will tend to ignore it. So it's for me, it's and this all comes down to, and what I would say is, a lot of people have asked me, I'm taking a step back and I'll keep it quick. What is it that you're looking for, Ross? What do you want to see? I mean, sure, a follow through day, we can all count the follow through day. I'm going to tell you that for me, I've been at it, I guess, since 1998 to put food on the table. I have noticed for my style, when the market has bottomed and we are really, that the qualitative evidence to me, or the signals, or when I start to see, and it's very obvious, and if you have the patience to wait for it, you will see groups of whatever those leaders are. I prefer the traditional leadership as opposed to, an S&P led rally with oils and energy and cyclicals leading us like we have this year for the most part up until now. But anyway, so yes, if you want to see that positive, healthy, constructive price volume action, big gaps, tight ranges, that sort of thing, and then again, everything else we discussed before with it. It's a weight of evidence thing. You want to really have like a solid footing underneath you, or it's like counting cards. The deck is hot or it's not hot. So to me, the deck's got to be hot, and if it's not, I will sit on my hands.
Yeah, perfect. So moving on to our next setup is the consolidation pivot. And once again, this can occur up the right-hand side of the base, and often it coincides with when we actually want to be buying that launching pad setup, or when we want to have that confirmation along with that descending tops line. So Ross, I'll let you kind of talk through the consolidation pivot. Sure. And yeah, go ahead.
Yeah, so very simply, consolidation pivot in many cases will look just like a base breakout pivot, except that it's going to happen earlier in the base, right? So for an official base breakout pivot, you've got to be within a certain amount from highs, and in many cases, this is getting you in much lower down in the base. So you will see, again, we've got, that bottom form, we've got that red hammer candle, and even though it's red, you see how we actually closed much closer to the highs of the range than the lows. That's letting you know, even though we closed down that day, I would consider that day more of a sign of accumulation than distribution, even though it's a red day like that. And so you can see the consolidation pivot right there. I mean, you could call that a mini head and shoulders bottom, another little. The bottom line is you're seeing the big volume on the upside. You're watching it tighten up as it comes into the average. The moving averages are crossing, and you can see the horizontal line is where your consolidation pivot is, just above the moving average cross, and then again just below where that 50-day moving average is, which coincides with it 65. That's going to be the next spot that you would pay attention to in terms of pushing through. But again, it's just that simple. If you know what a regular pivot looks like, basically it's pivot points that form that Bill would tell you are way too early is a consolidation pivot. Again, you have to have everything else working for you, because it's a riskier spot technically to be buying a stock than waiting for it to come all the way up the right side. But we have now figured in, especially if you're managing a little bit more money and you want to really start building positions, trading around your cores, that sort of thing, following these three simple, easy to spot techniques, and the more they line up and the more you can get going behind you, you'd be surprised. So the market this is that point where the market cleans up your mistakes instead of exacerbating them. And I try to only trade when the market's doing that for me. I'm going to be honest with you. And over time, don't lose money. If you can manage risk, be patient, and minimize your losses, it's just pure math. If you continue to follow the discipline, the profits will come. It's the patience and everyone trying to bottom guess and chopping themselves up, I find, on the way there, that is where a lot of losses occur, as opposed to waiting for the, everything to line up and then making mistakes when everything is working. It's typically not you and not your system. More often than not, if you're doing things right, it's the market, not you. So.
Yeah, perfect. And just to go along with that before we move on to this example, what we're talking about today are a few different setups that you can kind of chain together, and we'll have an example about this later, and build into a position over time, managing risk along the way. And we'll kind of talk about that with one last example. But yeah, we kind of went through the consolidation pivot. So here's another example here. Actually, let me go back here, where we've got that bottom form off the moving averages. We've got the consolidation pivot. This is the first early entry point. And even after this point, we get a push up, and then it goes tight again. This is another potential add point here. Very constructive price and volume action. And you can see the explosion in both price and volume. That's exactly what we want to see. So Ross, anything else to add about this example?
Nope, you got it, thank you.
Yeah, perfect. So next up, let's talk about the volatility contraction pattern. And this kind of links together kind of what we've been talking about here. And it really just kind of summarizes what we're looking for in terms of a constructive base. So this VCP, the volatility contraction pattern, it's a phrase coined by Mark Minervini, but going back in history, we've seen it's been called a coil, it's been called a spring, whatever you want to call it. It's basically constructive price and volume action, where within each of these pullbacks, we see more and more supply, more and more weak holders being wrung out of the stock with each pullback. And eventually, once all that supply is out of the stock, that's when the stock is ready to make another significant move, as Tesla did here in this example. So what we look for in terms of setup is we always want to be trading with the longer term trend in mind. We want to see that strong overall uptrend above a rising 200-day moving average, ideally. Then we want to see price and volume contractions from left to right. Here I already pointed out the kind of different coils here. You can see how it kind of gets shallower and shallower with each contraction. And along that time, you can see the volume's got an overall descending, basically trend here. And then once we start pushing up, we start to see volume increase once again. But once we see that contraction in both price and volume, that's basically when we want to start paying attention. Additionally, we already went over consolidation pivots, and basically the buy point for the VCP is a consolidation pivot right at that last contraction. So here we've got very tight price action on low volume, and we get an increase in volume, not higher than average, but higher than the previous few days. And then we get that nice breakout, and it even sets up one more time after really low volume, and we do see that volume come in, excuse me, and then we really get that explosion in both price and volume. So that's the VCP. Going through one more example, we've got Shopify back from 2017. And going over and looking at this chart, we've got that strong prior uptrend tightening from left to right in terms of both price and volume here. And this is a clear example, volume explosion, exactly what you want to see on that breakout. And you can see just from this point, we start a really strong trend above the moving averages. So that is the VCP. And moving on to kind of the last example in terms of the setup we're looking for, let's start with the overall edge. So this is what we call the volume, the highest volume edge. And this is basically looking for the highest volume over a certain span of time. It can be from a last earnings report. It can be from the IPO week. It can be the highest volume ever. We've got a few listed here. And essentially these volume signatures, when paired with catalysts such as a news event, like a new CEO, a new product, or an earnings report where they blew out every single metric, these are definitive spots where institutions change their mind about a stock and can potentially start accumulation, which leads to those strong trends. So in terms of the actual setup that we use to trade these, this is called the highest volume close setup. And we see it all the time where we're scanning for a stock, we see a stock break out huge after earnings out of a base, and it feels like we missed it. It's already up 20%. But if that is an early stage base, a nice longer term base, it often just marks the start of a potential uptrend. And this setup here allows us to get in on day 2 or whenever we push through that highest close and get basically on that train. So once we've identified that edge, HV1, HVE, HVLE, HVIPO, basically this is the entry tactic that we use. And this setup offers a technical entry area to manage risk tightly around, and the clear pivot point that we're using is that close on that high volume day. And I think this is a really important reminder here. A lot of these setups we talked about how the market is super important, and this is no different. We want to be an environment where we're seeing a lot of earnings gap ups, we're seeing a lot of this type of setup work, and that's when this is going to be most effective. So here's the first example for this setup here, the high volume close example 1 from 2020. This is GRWG, and you can see here we've got that huge gap up on earnings. This is the pivot point right here through that high volume close. And I think this started a 50-60% move in just a matter of a few days. And that really shows the potential of this setup. And it's really important that this is a momentum setup. It can feel risky because you're buying after it's already moved up 20-30%. But if the volume is there, if we've got that news catalyst, and if you're managing risk, that's key. This can be very lucrative very quickly. So that's example number 1. Moving on to number 2, we've got Tesla back in 2013. Even Kathy pointed out this chart on a weekly a few times here, but here we've got that earnings gap up, and then once again we've got that push through that close, which is that pivot point, and you can manage risk at the low of that day to day, or on an intraday basis at a higher low, and whatever your entry point is, you can kind of be a little bit creative with this. This latched on to a super powerful trend, and we throw Anchor VWAP on here as well, because something we like to do is place that type of indicator on that high volume gap up day and use that as a potential area of interest as the stock pulls in. You can add it as it bounces back from that point. And we also like to look for respect from the 23 exponential moving average once we do see this type of action. Moving on to example number 3, we've got AMBA back in 2021. Once again, we see that huge volume. This is really the key thing here, signifying a change in the institution's perspective on that particular stock. We get that breakout through that high volume close, and this led to a super powerful trend above those key moving averages coming out of a very strong base. And one additional thing that I want to point out here is you can see within the base how low the average volume is. And then once we get this definitive breakout, look at how volume really expands, showing that institutions have more interest, there's more liquidity, and that helps all around for institutions to position. And that's basically created because those institutions are slowly accumulating after that kind of change of perspective. So that is the HVC. And next up, because we've talked about this a few times, and this is really the most important thing, Ross, you'll agree here, let's talk about risk management and kind of how to apply it in terms of the numbers, first of all.
Yep. So, in the very beginning, like I said, you've got to get that market direction right. That's, plays right into this, the whole risk management and keeping risk reward on your side. But this is directly applying to your losses, okay? Again, I'm going to go back to, Bill O'Neill's book, How to Make Money in Stocks. His maximum stop loss in any given scenario is going to be 7 or 8%. And so this chart will, give you a pretty clear view as to why. So a 7% loss, 7 to 8%, you're not taking that. It doesn't take that much to recover. And also, you really don't want to be losing 9, 10+%, especially if you are a position trader and have started off with a reasonably sized position. So, and you can see here, 20% loss is now going to take a 25% gain to recover, and we don't come across 25% gains all that easily, although that, I guess, is reasonable versus the loss. But you can see how exponentially this becomes much more difficult once you start to draw down a third or half. You're looking at a 50% or 100% return just to get back to even. Most people are lucky if they make their 50 or 100% over years, rather than in 1 year or months over 1 year. So this is just giving you a very, picture's worth 1,000 words, why it's so important to manage your risk, especially your stop losses. My number 1 rule, don't lose money, legitimately. So, and this is exactly why. And here, I'm not going to go through and read all these. That's the whole point of these high value entry or alternative entries, early entry points that we've been discussing is exactly for this reason, to make managing risk that much easier. It protects your financial capital, and you will realize with experience how much it really protects your emotional and mental capital as well.
Yep, absolutely. And getting into a few examples here, just kind of applying risk management. This is a trade I took back in the later half of 2021, DocuSign. It had pushed up super strong from an earnings gap, and actually there's another perfect example of an HVC. If you buy right through that close, you can see how you can really get involved on that day 2. And then we had a beautiful trend and then the start of a basing pattern as it really was approaching those all-time highs, set up a little bit of a base and a clear pivot through these highs here. So I bought it right through that level. It acted well, acted like a breakout, like you basically want to break out to do on nice volume. But then the next day what happened, it completely reversed, took out my stop loss, and it was a 3-4% loss. I don't remember off the top of my head. And that can hurt. I know stop losses, they're frustrating sometimes, but I'll definitely exchange a 4% stop loss for protecting myself from a 70-80% drawdown, which now you see in DocuSign. So this ultimately, I believe, was the top. I think it rallied a little bit into moving averages and curled over, started to stage for decline. And from this point, wasn't really actionable at any point after that. So that is why stop losses are so important, and having that clear pivot point allows you to know when you're right, when you're wrong, and once it violates your stop, you're out, no questions asked. Next up, just talking about the overall trend changes. So this is more about when you've already got a position and why you should really look at that weekly chart, look at that weekly trend, and that really shows you whether overall the stock is still under accumulation by institutions or if you've got to transition over to a distribution phase. So here we've got Shopify, and you can see it's run all the way from down here all the way to up here. During this period, we're in a strong stage 2 uptrend where we're trending above a rising 30-week moving average, this red line here. And then at this point, we start to see the ascent, the rate of ascent kind of slow here. It starts kind of really bouncing back and forth along its 30-week moving average, and it enters more of a stage 3 within the stage analysis from Stan Weinstein. And that's when you really want to be careful, because that shows you that maybe there's not too much life left in the stock. And from that point, you're watching for an undercut of that moving average, a downtrend to begin. And that's exactly what happened right at this point. We have a break under that moving average and even a break under the 10-week moving average, this blue line. And we see that 30-week moving average start to downtrend here. And that's when you want to be careful, because this is really when the disasters start to happen. This is when the weekly trend changes. So I think during this period, just over the past few months, it's been tough. And this is because a lot of those growth stocks from 2020, 2021 that were working so well in strong stage 2 uptrends transitioned very quickly over to a stage 4. And basically a lot of distribution happened for all. So that's why you want to respect basically the weekly trend of the stock. Don't fall in love with the company just because it's made you a whole bunch of money within the stage 2 uptrend. Pay attention when it enters a stage 3, and definitely pay attention and consider selling at least some of your position once we do enter that stage 4 downtrend. So with that, we'll kind of walk through kind of a summarizing example, talking through kind of how to build into a position, combining some of these setups. And Ross, I'll hand it off to you.
Thanks, Richard. So I'm not going to spend too much time here, but we can see in our first consolidation here, marked by that launching pad setup in the series of consolidation pivots and declining tops line breaks. Very similar to the examples we discussed before. This first time around, this setup doesn't really work. However, it gives you plenty of time to get out of the way before you actually get to the consolidation that builds a proper base and works. So you can see where all of those entries are, and you can see after you get a little bit of a lift. And fortunately, you've got plenty of time to figure out how you're going to get out of that trade with minimal losses, if not a small gain. And so not only, again, are you protecting your financial capital, but as you watch this thing first it starts to tighten up, then it gaps down below an average and really starts to roll over. And just when it looks like it's probably going back to zero is, when you start to put in that bottom. At least for me, usually when I start to think a stock is going to zero, we're pretty close to a bottom. And you see within a few days, we're starting to push up into those pitches. As we pull back, we actually start trading a bit tighter. The volume dries up a bit, and you see we've got a solid respect for that orange line, which is at 65-day exponential moving average. And then from there, we start to get the moving averages crossing. That's our big launching pad setup, and it lines up with our declining tops line. I don't know if we have it marked, but there's yep, it is there. Consolidation pivot there too. So that's so there's going to be times, just like there's never been a new bull market that wasn't first preceded by a follow-through day. However, not every follow-through day leads to a bull market. This is the same thing. Not every launching pad setup with that you're going to see is necessarily going to work, but the beautiful thing is 9 times out of 10, it's going to give you plenty of time to get out of the way because it's so early in the overall pattern.
Yeah,
And then
perfect.
anything to
No, nothing too much to add, and we've got kind of a written explanation here. If you really want to go into the details, you can review this. And that's pretty much it for our presentation. Just a quick summary. First of all, it all starts with the overall market environment. Is this a time where you really want to be aggressive, accumulating positions? Stocks are breaking out of clean bases. We're seeing those work and fall through, trend above moving averages. Or is it a time like today where we're in a downtrend below those key moving averages? Volatility is high. That's a key thing to consider when deciding whether you're going to use this type of setup. Then we want to focus on high potential stocks where we see, those disruptive fundamentals, super strong price and volume action as well. Then basically, as we've talked about today, you want to go back to your setups that are effective and repeatable over and over again. The launching pad setup, the consolidation pivot, the descending tops line, VCP, whatever you want to use. It doesn't have to be our setups, just something that you find and you trust and appears over and over again in the market. And then most importantly, you've got to manage risk. That's the most important thing. That's what's basically going to keep you in the game over the long run and keep you active and able to basically profit from all the bull markets. So with that, I know we've thrown a lot at you, so we're happy to take any questions you guys have and any clarification points as well. Yeah. Yes, no problem. Yeah, right there. Yeah, that's a good question, and it's a little bit up to you. I personally like to use the low of the day, and I kind of go to a lower time frame, maybe a 65-minute 65-minute chart, 15-minute chart, and see as it turns, and then use that low of the day as my stop. But that's a little bit more advanced. But usually the low of the day is my answer. Any more questions? Yeah. Yeah, great question, Gav. Always ready with that. For me, you can follow me on Twitter at Richard Moglen. In terms of overall TraderLion, you can find us at TraderLion.com, and we're also on Twitter at TraderLion and then _ at the very end. We're also very active on YouTube. If you just search up TraderLion, you'll be able to find us pretty easily, and we've got great tutorials. We've got interviews with market wizards like David Ryan, Stan Weinstein. Highly recommend you watch those interviews. Yeah, that's where you can find us. Thanks so much, everybody.
Thank you, everyone.